Hello, this is Brian Shannon from AlphaTrends.net. Today is Friday, the 2nd of May, 2008. The market's closed, and we're going to take a look at the action here in a moment. Wanted to let you know that my book is available for shipping probably in the next 4 weeks, and I'm accepting orders at technicalanalysisbook.com. There's one of the reviews from David Nasser up there right now on the screen. And at technicalanalysisbook.com, you can see a bunch of other reviews as well, as well as the ordering information and a look at some of the sample pages like we have here. It's pretty cool. You can flip the pages and get a feel for my writing style and what's in there and that sort of thing. So definitely go ahead and take a look at technicalanalysisbook.com. And let's take a look at the markets now. The S&P 500 did finish with a gain again here. 37 cents was the final closing number today. You can see it's still below this declining trend line as well as the declining 200-day moving average, but it's on its way up towards that 200-day moving average, it certainly appears, after breaking past that important resistance definitively yesterday with its push past 140. So right now we've got this market looking like it's heading up towards the confluence of these three important levels, which are one, the December lows, two, the declining trend line, and number three, we've got that declining 200-day moving average, which has the potential still to act as resistance. And again, I want to stress the point that moving averages should never be used as a system, and it doesn't really matter whether you use a simple moving average or an exponential moving average, because they're not being used for a system, but rather a place to say where are other buyers and sellers looking at this market to take action or to not take action, that is to stop buying when it approaches that declining 200-day moving average. And on the weekly time frame, we can still see that we've got reason for concern here. But again, the bigger picture is not going to pay us for our shorter-term trades, and the shorter-term trades need to be based on these shorter-term time frames, and that's what the book is all about, is recognizing which time frames make most sense to you, controlling risk, and looking for the highest probability trades based on trend alignment. That is when we have trends across multiple time frames giving us the same message. Here we have these markets still giving us a mixed message because we've got the weekly time frame still looking troublesome in here, but the daily's been clearly much better looking. And when we drill down to the shorter term time frames, again, we've got the 30-minute time frame up here now, and we broke this uptrend line earlier in the week, but the market was unable to break through support levels. So the buyers came in yesterday, and today we had some news that motivated buyers, the jobs report to motivate buyers at the open. However, a lot of people took advantage of that by selling into it, and you can see that for most of the day the market was below its declining VWAP. Based on yesterday's trading as well as today's, the average price is at about 140.62 or so. So realistically, a very good week for the market, as we're closing in on nearly unchanged for the year. The market's S&P 500 closed right about there for the year, and right now we want to early next week. The market has expended some good energy going forward here the last few days, but right now it looks like we've got some support, I think, in the range of 140 to 140.50. Breaking below 140 definitively, then we've got to become more cautious and maybe look for a test of 138. But clearly we've got a very nice trend here, and that's what pays us in the short term. Let's take a look at the financials next. Financials, as we know, broke this downtrend line that we've been monitoring here for the last several months, and it was looking last week like a bull flag. And I was saying that to take the height of that pattern, what we would do is we would take the low basically here of this flagpole, which is about 25.35, go up to the high in here. The high was 27.02. So we've got about $1.70 or so from the break point, and it basically broke past there at about 27.20. So that would give us a price objective up near about $29 a share based on that bullish flag pattern that we have in here. So looking at the 30, or let's take a look at this hourly time frame, because in here we can also see that the important resistance level that was broken was this trend line in here, and then we saw the 2740 level taken out. So now we want to see basically 27.20, or about $27.10 to 27.40. That level ought to act as support for this market right now, and it's good to see that we moved clearly above that 26.20 level that had been so important for such a long period of time. And this market's making this pattern of higher highs and higher lows, so perhaps we can continue to see some upside in here. But again, the weekly time frame is deeply damaged in here, and these rallies you have to be very quick to take your profits, because when they fail, they'll typically come all the way back down, typically to even that 50-day moving average near about $26 a share. So short term, the trend is higher. It does remain a risky trade, so just continue to protect your profits and don't be lured into a false sense of security. Just because prices are rising now doesn't mean they will remain that way when we have a much larger bearish picture. The IWM Russell 2000 did make it above today. It did make it above that $73 level, but was unable to hold. And again, that's really, the IWM was the big group that really broke down after the financials first, and below that $73 a share. My scaling seems to be getting messed up in here, but this is clearly a very significant level that if the market could break above it and hold above it for maybe a week or so, then I think we would have a much different picture, and we could call it a lot safer to enter for a longer term perspective. But right now we had the confluence of this prior support level, which was also resistance numerous times, come together with this downtrend line, and the market rallied up through that $73 level, but was unable to hold on to it. In fact, lost 23 cents today, while most of the other markets gained. So you want to just be, again, on high alert when these markets are looking bullish on the shorter term time frames. You want to trade bullish, the bullish scenarios, but when they fail to hold on to moves like this, raise your caution, raise your stops, because a lot of times from failed moves come fast moves. Not every single time, but here we have the potential for failure. The important levels really are, the more important levels probably down near 71 and a quarter. So I think getting below that level, then it could lead to a further consolidation that might see it come down towards a 20-day moving average. That's the 20-day moving average is actually right around 71. So perhaps we could even see it fail to an area near 70. It doesn't suggest that here yet, but the failure to hold on to these gains with good news. So we've seen this market rallying on bad news, and then today we saw good news on the jobs report, and the market was unable to hold those gains. So is that what the market's been anticipating, and now the people who have been anticipating were selling into that? So you have to just be very cautious still. And that's something I continually say on all time frames until we have a more confirmed pattern that's consistent on all time frames, and we don't see that here. Here in the Nasdaq 100, another great week for the Nasdaq, and in fact today it was up another 7 cents. But on the week, you can see this nice green candle in here. It is getting up to this level here where we've seen the important level where the market broke down from near about 48.70, $49 a share. So that's looming ahead. We've got, again, this market was the healthiest as it broke past its downtrend line. It still has a declining 200-day moving average. So I think it's, it would be very healthy for this market to settle in above that 200-day moving average and heal a little bit more through time. Right now, the market's expended a lot of energy. Doesn't mean it can't keep going higher, but clearly risks are a little bit higher in here. I think your first significant support should be near $48 a share, and then some of the trend lines potentially, now near $47.50, and then $47 a share. But clearly, this market, had a great week, and we're close to, unchanged for the year. We're just a couple percentage off on most of these markets. So take a look at technicalanalysisbook.com when you have a chance this weekend.